Welcome to this episode number 96 of Your Next Trade, called today Tesla Crashing. So as always, if you like what you'll be watching today, please put a like, subscribe to the channel, put a comment. So a lot of things to discuss today, and as always, we're going to be starting with what the market has been discussing. Some of the part has been about Tesla. So the stock has been under pressure over the last few weeks, mostly since mid-December. But as always, we need to be looking at things and put things into perspective. And I would like to share this chart of Tesla versus the other fabulous 7. And as you can see here, this is the red line of Tesla from end of September until yesterday or 2 days ago. Tesla has been outperforming the market just after the election. Makes complete sense because Musk was supporting the Trump administration and benefited mostly thinking that they will get a lot of business from Trump administration. And since then, over the last 3 months, the stock has been under pressure. But if you look over the longer term, if you look over the last 3 to 4 months, as you can see, the stock has been doing roughly like the other fabulous 7. So we had a bit of flows going into Tesla just after the election, and a bit, it's an understatement. We had a lot of flows going into Tesla. There's still an army of cold buying, of retail buying. But we should not be looking at the chart over 3 months. If you look at the chart over the last 10 years, actually you see that Tesla has been massively outperforming. But as well, there is a question of valuation. So on one hand, you got people telling us, this is robotaxi, that there's going to be robot, that the valuation should be multi-trillion. And on the other end of the spectrum, you got people telling us, actually the valuation should be like an auto company. And that means if that's an auto company, the stock could be going into the 50-100. So later we're going to be looking and do a bit of dodgy technical analysis. But that is for the Tesla. The market overall, what has been happening, and this is most important. Year to date now, the S&P is roughly down 4%. With the Nasdaq still underperforming 8%, we're still having Europe doing very, very well. So on Tuesday, Germany voted for this fiscal bazooka of 500 billion over the next 10 years. So that helped the overall market quite a lot in Europe. The expectations now are starting for 2026, the German GDP growing by 1 to 2%, because if on one hand you're running a deficit and putting more expenses, guess what? Your GDP is going to be bigger than what it was expected to be 6 months ago. But coming with that means the cost of money is going much higher. The cost of debt has been up 30 to 50 bips, 0.3% to 0.5%. And I still want to believe that nothing is clear for Europe. It's not because you're going to be putting a bit more money into defense that is going to be helping a lot. There are still fundamental questions about Europe, and that means that some countries, and I'm talking, my own country, France, could be under pressure because that doesn't mean that France will be able to be spending more money. It's just for the timing that the cost is much, much higher. But I'm interested into the week-to-date asset performance. As we saw and as we discussed last week, we thought that the end of the sell-off was coming after selling off by 10%. So we had the first phase of this sell-off, which is the normal drawdown of 10%. And the question going forward is it just only this 10% drawdown, or are we going to have more? If the market is going to be selling even more, that means we are going into a recession. Normally, you're going to see every year a 5 to 10% correction. This is normal business. For the 20, 30, 40%, that means recession. We saw from the start of February onwards that the expectations of growth have been coming down, started with the Fed Atlanta, but now the funny thing is all the sell side, we are talking JP Morgan, Goldman Sachs, all those guys now are downgrading their expectations for the GDP, not only for Q1, but for the whole year for 2025. So now we are trending for 2025 around 1.5%, which I think is still optimistic. So week to date, if you look at stocks, they have been doing pretty okay. If you put aside China, so China was a bit under pressure. The Chinese ADRs actually were down 3% for the week after a very strong run. We had a bit of trading sideways for the dollar. We didn't put here the dollar versus the Turkish lira. We're going to be looking at it when we do the technical analysis. Gold up and up and up above $3,000. WTI up as well. So that's an interesting chart that we're going to be looking. And copper. So there is copper is making new highs after new highs. So this is a space as well that we are looking. So what about the week-to-date industry performance? So I want to be putting, as always, the S&P 500. And as you can see, S&P 500 is roughly at the middle. So there has been dispersion in the market over the last 5 days. On the right-hand side, you do have the brokers, dealers, the retail, airlines. So cyclicals have been doing a bit better. On the left-hand side, silver, which is normal when you are talking about, market doing a bit better. So dispersion, not much visibility for this market. So far, the Momo stocks, the momentum stocks have been doing pretty well over the last week. So what about the sector performance? And this is energy. So energy up 3% for the week as we see oil is bouncing into the 65 and now trading back into 68, 69. So for the Trump administration, which has been saying, we're going to be putting oil much, much lower. Actually, if you look at oil, this is exactly at the same level that it was at the start of November. So not much of a change over the last 2 to 5 months for oil. Utilities, consumer staples, quite the defensive, underperforming the overall market, and actually financials doing fine. They have been struggling. If you look at JP Morgan, this is a chart that we have been flagging. They have been struggling most recently. So what about the rates? 10 years at 425, we have been discussing the range, which is 420, 470 or 4.1 to 4.7. We'll see. Market is expecting new inflation numbers at the end of this month with the PCE, but the issue is not on the inflation. So if you look at what the Fed has been saying on Wednesday, they lowered their growth expectation for 2025, and in the meantime, they put higher the inflation expectation. So inflation is expecting to kick in a bit due to tariffs, and in the meantime, you do have not such a good growth, but as well, you do have a lot of bond supply, bonds, because the US government and some other governments need to finance the deficit. And that means every single week, every single month, you do have a lot of bond supply coming into the market. And when you are putting paper in the market, you will need to have higher yields to find an equilibrium. 10 years versus the 2 is at 0.3%. What about the Fed funds rates? Looking at the December, we do have roughly 2.5 cuts until the end of the year, and we should expect the first cut roughly in July, meaning this summer. I would like to talk about the VIX as well. So now we are below the 20% for the VIX, for the S&P 500, 30 days volatility. This is not perfect, but volatility, as we can see, has been on the rise. Now the VIX do have a normal shape, so there is less pressure, less tension than there was a week ago or 2 weeks ago. VIX 9 days at 18.58%, so we are coming from high levels. If you want to go back into the normal level, you should be targeting, the 11, 12, 13%. So market after risk off that was until a week ago now is a bit waiting for the next waves of news, and mostly this is going to be starting with the 2nd of April with the tariffs. So now I would like to jump into the technical analysis, starting with, as always, with the S&P futures. So as I said, this is an important point that we have. As always, I call the technical analysis a bit dodgy, but we have a bit of consolidation after this sell-off that went from 6150 into the 5500. That was the easy sell. Okay, so that was after the hoo-ha phase that the Trump administration will be doing everything that now the market is putting into questions. So that was the first phase. Now we are, as I said, kind of questioning, are we going to go into a recession or not. So on one hand, you have still Trump administration saying this is fine, and on the other hand, more and more analysts questioning this this growth going forward. And Q1, this is for the Nasdaq futures chart is consolidation. Not great, to be honest. It feels very much like it's going to go lower, but we have a good seasonality here. I want to be jumping into the CL1, which is for oil WTI, and to explain to you that despite all the noise, oil is pretty much at the same level that it was since September. So we had the spike just after the election, but roughly this is the same as before. We are trading into the low 66, 67, and that has been for months and months. Another chart that I want to show you is obviously the Turkish lira that has come under pressure due to some uncertainties and some political decisions in Turkey. We had a big move on Wednesday, and I heard that some prop desks were badly positioned. So this is that explained the 36 to 41 level, but mostly there has been poor liquidity when it moved. Then it retraced on the day, but with the Turkish lira, that has been the big picture, with really weakening and weakening. That has been a one-way traffic. I want to discuss as well the Fabulous 7, looking at the big names. And as you can see, the chart is the same as the S&P, the same as the Nasdaq. We are consolidating after this not a big sell-off, let's say this drawdown of 15%. As we do know, the Fabulous 7 has been underperforming the overall market. There was a strong day on Friday, especially if you look at Apple and Microsoft. They jumped in the last 10 minutes of the session, mostly because of some rebalancing from indexes. So we should not be reading too much into that. Tesla. So as we discussed at the start of this call, this is Tesla. This is the chart. To me, it is telling me that we're going to be going into the 180, 185. I don't have any position. I've not been trading Tesla for quite a long time because I don't like the noise, and I don't think that I have a lot of edge when tons of people are trading the same thing. But to put again everything into perspective, this is the move that we have during the election. Now we're coming back to actually pre-election level, so not much of things to do about this jump, but roughly what we have, we do know that the sales of Tesla are coming down both in China due to competition and some as well for the rest of the world because of the perception of Musk. This is just fact. We do know that the sales are going to be down, and actually this is not abnormal to think that the stock could be going lower. Finally, Accenture that we mentioned last week. This is the Doge story. We said that we liked the stock as a short. It played very well on the earnings day, where actually the earnings were okay, but the expectations going forward are not great, especially due to the exposure to the government's contract. So doing very, very well. We are short another name in Europe, Etienne. Our other mentor put a very nice short on Capgemini, which has been doing very, very well. So let's jump back into what happened for the week. And as we just mentioned Accenture, I want to flag a bit, sometimes we are making some good calls. So on the at the start of December 2024, we said to the trading community that Accenture was a potential short due to the exposure to the contracts of the governments, and that played very, very well, as we saw on the chart just before. And if you listen to the earnings call on Thursday, so more or less what they said is 8% of their revenues worldwide are under pressure, and we are talking 60% for the Americas. So that's quite a significant part of their businesses. But what I want to flag is, when we do the 4x4 video series, when we do the mentoring, we have a process. We look at how to generate ideas. This is professional. This is not just about looking at the chart and thinking, this stock is going to go down or up. So What about the S&P 500 over the last 5 sessions? As you can see, we have been oscillating between 57.60 and 56.60. So a trading range of 100 points, a lot of noise in between. What we saw as well, so from the OPEX on Friday, from the open, which was roughly at 56.50, then we rallied because we had a lot of position for the futures that were around 56.50, 56.60. But overall, not much of a direction. That means an overall market flattish for the week. So we've done the option expiry. We had the German bazooka, so much more volatility in Europe to the defense stocks and some others. So actually that was very interesting for if you are trading, actively trading. Europe, Germany was pretty good for trading. Finally, FOMC meeting. As I said, I was on Wednesday where Powell said we're going to have higher inflation going forward and lower growth. So this is not a good package for the economy going forward, and that means the Fed is not in a hurry to do something. While my conviction is still the same, something that we discussed a week ago about the high yield and credit market going forward. The only way that the Fed will quickly intervene will be if we see some pressure in the credit market. This is what happened in 2020. This is what happened in 2008, 2009. One of the, let's say, mandates of the Fed is to make sure that the financial system is working well. As long as credit is working well, they will not be jumping too quickly. We had as well the core retail sales month on month, or the retail sales for the US. January is very often there is a bit of seasonality around the start of the year to the change of numbers. So there is questions about how the US consumer is doing these days. We saw from many retailers that the numbers have been lowered a bit. Question again, especially to the perception of this new Trump administration. So let's see, numbers were kind of okay, a bit lower than expected. So what about the catalyst going into this week? We do have the flash PMI on Monday. So this is for you US services PMI, which has been coming down into the low 50s. So what we had over the last 2 to 3 years is services doing okay, holding pretty well when the manufacturing was below 50. Now manufacturing is doing a bit better on the way up and services coming down. So this is the space to be watching for the macro, not only for the US, but for the rest of the world. At the end of the week, we do have like inflation with the PCE. We had CPI, PPI a week ago. We do know that inflation has been coming down. But as I said, now the FOMC market participants are expecting higher inflation due to tariffs. We do have for the UK the budget on Wednesday. This is important. Why? Because the credit market so far has been fine, but it's going to tell us, how the 5 years, the 10 years in the UK and Europe will be doing going forward. A bit of earnings and conferences ongoing. We get, for example, Lululemon that I like to be trading, so it's on Thursday. Some market participants with the Fed, but a lot of debt coming into the market. Like always, at the end of the month, we have a lot of bond supply. So flash PMIs, PCE, bond supply. We do have as well, as you remember or not, if not, you should be watching last week or 2 weeks ago, the JP Morgan Cola explanation, telling us that, a big magnet for the market is around 55.60 for the S&P. We are trading 100 points higher, but that should be, for the time being, the magnet. What about the expectation for this week? We are expecting a 1.9% move up or down. And we do have on the 2nd of April the tariffs that should be coming into play. So it's only 10 days from now. That could add some volatility. And finally, this is the chart that I put, I don't know, this is from here, the Bank of America. This is the chart about if we do have a recession or no recession, by how much we should be coming down. And again, when you look at positioning and let's say recession going forward, you should be looking at how much, in a normal recession, the market has been coming down. This is something that we covered in detail in the 4x4 video series because recession happens only 10% of the time. It happens 1 to every 5 to 7 years normally if there is not a fiscal bazooka or monetary bazooka, and we are interested into by how much in that case the market will be coming down. So this is it for me for the week. If you've been interested in what we've been looking at is coming from a very deep and in-depth process that I share with the 4x4 video series. I do as well do the mentoring. Me and Etienne are doing the mentoring. We have a lot of people coming now. I don't know why. It's probably because we make some good calls. So if you are interested, you can send me a questions at Greg@Dupont Trading. You can join us on the trading community. There is a free channel, or you can subscribe to 30 channels where you could have access to ideas like the Accenture one for roughly $75 per month. So this is where we put research, where we put calls, technical analysis, a bit of everything that is, I think, very helpful for active traders or less active traders. So any questions, you can send me an email. We're probably going to be trying to do in 10 days Ask Me Anything session that will be probably on Wednesday in 10 days. So if you're interested, let me know, put a comment, and as that way I can know if you'll be interested. This is it for me for this week. Have a good trading week. Bye-bye.